What's going on, everyone? It's Ali and Julian here again with another episode of Personal Finance Boss, and I'd like to comment on Julian's haircut to begin this week's episode. It's very nice, and he is
no comments.
So, ladies, he is available for a trim or something like that. Maybe we can take all of it off.
I'm planning on doing the opposite.
Oh, okay.
Growing it back.
I see. Well, we have an interesting topic for today, and we will be talking about financial mistakes. And not just stock market or investing mistakes, just financial mistakes in general. And we'll just see where it goes from there.
See where the night takes us.
See how many wrong things we've done in our past.
Well, not even things that we've done, but things that we can advise people not to do.
Mm-hmm.
So take it away, Ali.
I'm going to take it. Okay,
what would you say?
I will start with an investing one.
Okay.
And that is the mistake of overtrading.
Okay, explain.
So overtrading, I don't know how to explain overtrading. Like, there's no definition of it, but overtrading would be trading more than usual, I guess. Well, it's not like a fixed definition of trades, but just when if at the end of the year you're looking over your account activity and like every other line is like trade, then there's probably something wrong going on.
I remember when we first started trading, we were like 18, 19, whatever, and at the end of the year we would look at our statements.
Yes.
And we would look at how much commission we spent, and it was like over $1,000.
Yeah, I think I had $1,000 in commission in my first year.
Our portfolio at the time was around $5,000, $10,000, nothing significant, and we spent $1,000 on commission.
Yeah.
So that would be a prime example of overtrading.
Yes. And I think the lesson you can learn from that is that stock market investing takes patience and time to reap the benefits. And I have the perfect example because from time to time, I'd actually go through my old account activity and see where those stocks I bought and sold are at today.
Yeah.
And recently, Questrade, for example, for whatever holding you have on your watch list, if it goes up plus or minus 10%, they'll send you like an IQ alert.
Yeah.
The stock has gone up. So sitting at my desk, there was a stock a while ago I bought called Amarin Corporation. It was a biotech corporation. They just got their patent and released their study for an omega-3 fatty acid prescription drug that is good for cardiovascular disease.
Okay.
So I'm sitting at my desk. Email comes in. IQ alert. I'm like, oh, this thing probably went down. It was probably bad or something. Boom. Went from $1.50 to $9 in one shot.
Oh my God. And you own the stock?
And I owned the stock years ago when we started trading. I think I bought in at $1.80 or something. So I'm sitting there, I'm like, damn, that feels really bad. Okay, but you know what? It was $6 a share. It was a long time ago. I only bought 40 shares. So I only lost out on $240. Okay. That was my reasoning. But percentage-wise, I lost out on like...
Yeah, an infinite amount of percentage.
A 10-bagger for sure.
Yeah.
So now, I'm sitting there. Next day comes, I get the same alert. It's gone 10% more. And for a series of weeks, I've been getting these alerts. And I looked today, I got another alert. It was at $19 today.
Oh my God.
So from my initial entry point at $1.50, and now we're at $19. So I lost out.
Did you buy it?
No, I didn't buy it. I was going to buy it at $9. I'm like, what if I buy it now? And I'm like, no, you never buy after good news. And I would have made 10 points. I would have made 100. I would have doubled my money already.
Yeah.
So prime example right there. There was another one also, I think, that was called like Intermune or something. I bought it at 50. Bam, like 3 months later got acquired at $79 a share.
Okay.
And then I have like maybe 5 or 6 of these examples. So it's taught me, Mark, it takes time. Trust your initial research and it's not going to go. I remember we were like updating our portfolios like by the second.
Every day,
like looking, oh my God, we made $10. Yeah. We lost 5. Oh my God. And then let's sell. But it takes time. It takes patience. And commissions cost money. Thank God we were at a discount brokerage. If we were at like the banks or TD or Waterhouse or something, it would have been like $10.95 a trade. Maybe that would have allowed us to trade less, but do not overtrade. Time your investments in the market. Make sure when you sell something, take the time to realize how much cash has come in and then make your trade. Like sell everything and then make one trade. Don't.
What does that mean? Sell everything.
So let's say, for example, you sell something for $2,000 and then you want to buy something for $3,000.
Yeah.
But you have a transfer of 1,000 coming in. Wait for that transfer to come in so you don't make 2 trades.
Yeah. Okay.
For example. So just try to keep your trades to one each way when you can.
Yeah.
One buy, one sell. And just try to keep it that way. ETFs are different because some places offer commission-free ETFs, so you can even buy one question offers buying.
I know,
for
but
free.
apart from them,
I think CIBC maybe started now.
Okay, that's good.
But other ones do. I think in the States some of them do. I don't know which ones off the top of my head.
Okay,
but some of them do. So those you could buy like one unit at a time if you have dividends or something come in. But that would be my numero uno financial mistake.
Number one financial mistake.
My number one financial mistake.
Interesting. Overtrading. Okay. Well, apart from the obvious financial mistakes like not investing or not saving money, stuff like that.
We're not going to talk about
exactly.
those.
We're not going to talk about those.
You guys should already know those. You guys should be investing and saving. You've been listening to us for a while.
Yeah, that's
See, Julian saved by having his haircut done by his girlfriend. So
exactly.
He's $20 in the green.
30.
30, wow.
35.
35.
It's expensive. My number one thing that I would say, and that a lot of people have complained about later on in life, is cars.
Mm-hmm.
Constantly leasing new cars is very expensive, apparently. I've never really done it, but if you think about it on the premise that, okay, my car payment's going to be $500 a month, which is, I would say, below average. If you take all the average leases, you have lower end cars and higher end cars, but you're getting an Accord, right? And it's base?
Mid.
Base
would be, I think base would be 400.
Yeah, so a base Accord, even though the Accord isn't a base car, but the base of that car is $400 a month.
If you go Civic, it'd be like 300.
Yeah, but 400 times 12 is 4,800, right?
Let's say 15 Gs. It's a round number. It would be C.
What do you mean 15? No, it's 4,800 a year.
Yeah. 20. Sorry. 20,000 over 4 years.
Okay, no, but it doesn't matter.
Okay.
Like, let's just say $5,000 a year, right?
Okay.
So every year you're spending $5,000 to drive your car, which does not include maintenance, even although when you lease a car, it's new, so usually there's not much maintenance to do. But there's $500 a month, plus insurance, plus the gas, blah, 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 blah. Yes. Now, alternatively, if you don't have...
maintenance is covered. Parts and stuff are covered. It's just an oil change.
Yeah, that's not expensive. Okay. Except for tires, depending on the car that you get.
Yeah.
But usually it's more spending the $500 a month, or the $5,000 a year for the rest of your life. If you would have leased an older car, or leased a less expensive car, but then you're still paying for a car forever. But pretty much my point is, if you were to finance a 3-year-old car or a 4-year-old car after the car depreciated by half, and if you can find a car that hasn't been driven too many kilometers or miles, that would probably be the best value that you can get. And if you can finance it over, say 3 years instead of 7 or 8 years, that would also be much better, because a car should last you more than 3 years or 36 months or 43 months or whatever weird amount of months that those leases last you. Right, so it should last you, like you've been leasing your car, and how many kilometers do you have on it after the 4 years?
I have 30,000 kilometers.
30,000 kilometers, and your max kilometers was like 16,000 kilometers per year.
Yeah, I think so.
So how much money are they getting away with?
They're getting away with a lot.
Yeah,
with you.
Exactly.
They're getting away with a lot. Yeah, no, but for sure, buying. You don't have to sell me on it. Buying is smarter than leasing for sure.
Well, it's not necessarily smarter.
From a financial standpoint,
from a financial standpoint,
a purely financial standpoint, it is. It's just
It's also the aspect of getting a used vehicle as opposed to a new vehicle.
Yes.
Getting a new vehicle is fun, definitely, but it's expensive, and you pay for it, and you ask yourself, is that added premium worth it, or should I use this extra, $200 a month that I would save and put it to something better?
Yeah. Makes sense.
Yeah, and that's I would say the number one financial mistake is someone I've heard, let's say from my uncle, he's about 55, 60 now, and he told me one of the things that he regrets the most when it came to money was changing cars so often.
Yes.
No, and, even though it's easy, you just pay per month. You get paid per month from your job, and then you pay for your car per month and the mortgage and everything, and then it all works. It's fine, but then you can't save for the future. What if you lose your job? There's a lot of things that can happen that would sort of inhibit your cash flow. but you're still stuck with your car unless you break the lease and there's stuff like that. But then you also may lose out because you may need to give the person incentive to take your lease over.
Yeah, or pay to break it.
Yeah, also.
But no, you're right. It is more expensive.
But if you can afford it, go for it, because new cars.
Well, no, even if you can't afford it, if we're talking about financial mistakes,
yeah,
but like your uncle can afford it, but
I mean heavily afford it. As in, like,
okay,
you don't care.
Okay.
We're talking about $10 million penthouses, like those people.
Okay.
Right?
Yeah, no, but those people also would live in a lifestyle where they would say, we're not buying, we're going to lease year to year and choose a new car.
Yeah.
Like every other time. Yeah. But based on like materialistic society where we're going towards, people don't heavily. Yeah. People don't like for example, I'm the same way with that with my phone. I do not upgrade. I buy my phone.
Yeah.
Until that thing does not turn on, I will be using it. Yeah. I use my old iPhone 5S since high school.
Yeah.
Since high school. And I only upgraded it because the battery went kaputs.
Yeah. But you still bought a new phone.
Yes, but I got a deal with Rogers.
Buy used phones.
Yes.
Anyway, okay, so what would be your next financial mistake?
Next one.
Or were you not thinking about it?
I was, but I'm trying to... The leasing one is interesting. I don't know.
This looks bad because it shows that we didn't prepare for the episode.
Oh, yeah.
Or maybe we did. Maybe I have my notes.
Do you?
Of course, they're all in here.
Are they written under the table?
They're all, yes.
But I think... let's see.
Okay, I'll go.
Yeah,
with
why
the
don't
next
you
one.
get another one?
I'll
think one. I'll think of one.
Now here's another example. We're gonna use real life examples because these are the most interesting, and people like stories. So I have a colleague at work, and he lives in a pretty good neighborhood now in Nuns Island. For those who are from Montreal, otherwise it's just a neighborhood that's pretty close to downtown, and it's pretty new and up and coming. Or not up and coming. It's always been a good neighborhood, but it's being heavily developed, so you pay a premium to live there. Anyway, so he was paying about $900 a month in rent, which included a parking spot, right? For a 2-bedroom, whatever, which is very good.
In Nuns Island?
In Nuns Island. Yeah, exactly. You make faces because that should be at least $1,600, $1,700 a month.
Yes.
But somehow he was paying $900.
Okay, good for him.
Good for him. However...
He left it.
He... and his wife, or it doesn't matter who's to blame. That's not the point. But the point is, him and his wife ended up buying a condo, right, in the same area, Nuns Island, for $370,000. Okay. Now, if people always say like if you own your place, it's good because you'll start building up equity in the property, and that's how you get started in life. And then when you have enough equity built up, you can go buy a house. Common wisdom, sure, makes sense. However, if you look at the interest and the taxes and the condo fees that he paid for the condo, forget the mortgage, forget the equity, all of the expenses that you'll never see again, meaning everything apart from the equity, was more than the $900 he was spending before. So now you can argue, if you took that, say, $1,100 that you were spending on taxes, condo fees, and interest, money that you'd never get back, and you'd invest that in the stock market, or put it in a stupid saving account that yields you 1.5%, which will pretty much follow the condo market, give or take. Isn't that a much better deal? You're not, and you have access to that cash anytime, and it's liquid. So now the mistake that I'm trying to say is, yes, owning is interesting. It could be beneficial, but you can't let the dream of owning your own home or owning your own condo or owning your own flat or whatever
kind of blind you
or overpower the financial common sense of renting. Are you thinking about an idea?
I have a couple.
Good. So it's just important to always run the numbers before you choose to buy or rent, because sometimes buying won't make sense and sometimes renting won't make sense. But there's like there's like this romantic view on owning your own property that
like a fantasy.
Yeah, like
it's been hyped.
It's like hyped, or the American dream or stuff like that. They sort of sell you on owning your own property, but in reality, it's not always the best thing to do.
You have to be smart, and like building on that kind of. I think there's a lot of ways. Like people, when they talk about money management and stuff, they always kind of jump to, like, we talk a lot about investing, but a big part of money management kind of doesn't even happen with investing or savings. I think being smart in realizing how, let's say you're obtaining credit through a line of credit or credit card, looking at the interest rates. There's a lot of people out there that use credit card, revolve their money from month to month, pay the 20% interest, but don't realize that they could easily get a line of credit at 5 or 7%, well, maybe 7 today, but it's still considerably cheaper than the 20%. And I think being smart in things like that these things that are readily available to you, for example, doing the contributions through your work, for example, a lot of companies nowadays will offer you put 5% of your paycheck in, we'll put 5 as well. Yeah. Even though you don't have control over your investment, it's invested there. Fine, you have to pay a policy fee, but it's free money. Free money. It's free money that's sitting there. And the same with the line of credit. That 13% extra, that's less off your plate.
And building on that point as well, which was another big mistake that I'm sure more people do than you think, is saving money and investing with credit card debt. Now, there's two trains of thoughts on this, meaning some people say, look, if you get in the habit of saving money and investing, it will serve you better in the long run. And I'm like, human nature, blah, blah, blah. People don't have the discipline to do it. So starting younger or starting despite credit card debt is a good idea. Like, sure, I can see why some people would say that. But if you take human psychology and human nature and you put that aside and you just look at the numbers, if you're spending 20% interest per year on your credit card and you're looking to invest your money, say in the stock market or real estate, the odds that you make more than 20% to outweigh the losses that you have on the credit card are so slim that it's not even worth it. You might as well divert all your savings and all your cash to paying off the credit card before you start saving. Yes. Because the compounding effect on your credit card is going to kill you. Yes. So that would be another huge mistake that a lot of people do. And I think they take credit card debt too lightly. Yes. 20% is not a feasible percentage for you to get in the stock market or in regular investments.
There's a whole, I'm completely on board with that idea of, let's say, for example, if someone said, Ali, we'll give you 25% guaranteed investment for the next 4 years. Yeah. I'd say, sure, I'll take my credit card, take the cash, put it in. I get my 5%, I pay off TD or whoever I'm dealing with, I'm up 5%. It's simple math. But if the person says to me, we can only give you 1%, why would I be so stupid?
Or it's not even that. It's, you can maybe make 25%, but there's no guarantee.
If there's no guarantee, it's really not worth it. And even as students, for example, I'm sure you get a lot of offers. The bank's offering you a student line of credit. You've already been pre-approved for $7,000. Yeah. That's amazing. Fine. Yeah. Go in and look at the rate. If they say it's, for me, for example, I went in to check the rate. They said, it's a great rate. We can give you 6.5%. Yeah. I said, no, I can't beat that. Yeah. It's very high. Now, if they came back and said, hey, it's going to be 2.5%, I'd say, sure. It's a much better deal. So you really got to look at the numbers, and that's something my dad has really kind of drilled in. He'll always look at the numbers. There's this thing when you go, for example, there's a thing when you go to buy a car, you can either put money down, which is you lose the money. It's a deposit. It's a down payment on the car. Yeah. Then there's a thing called a security deposit. Yeah. Which is kind of like a GIC. You give them, let's say, $3,000. It reduces your payment on the lease, or I don't know if you're buying it works like that, but for leases, for example, if let's say your lease was $450 a month and you said, here's a $3,000 security deposit, it's a refundable security deposit, they'll put it in and they'll say, okay, so that's going to reduce your payment now from $450 to $425, for example. Yeah. So now you're saving 25 times 12, which is $300 over $3,000 every year. So about 10%, a rough number. Yeah. So if you're looking at it from that standpoint, it's better to take your cash that you've saved, put it towards the car as a non-refundable deposit, and reduce your payments. Yeah. But a lot of people don't bring that over because they look at it as, I'm going to be out $3,000. Yeah. And the same with the savings. The savings one, it's actually more, why don't you start saving at the same time as paying down debt? So at least if you lose your job or something, you'll have something to fall back on. Yeah. Like, I get that kind of security. I get that security that's going on.
No, but worst case, you just take the money off the credit card.
Yes. But it's just it's the security then and the mental thing of, oh, I logged into my account, I have $3,000 in an emergency fund if something happens.
Yeah, no, but in the meantime, decrease the interest you pay on your credit card.
Yes.
And if you need the money in 2 years, at least it saves you that 2
That's
years
the
of
logical
excess
approach.
interest. Yes,
But
exactly.
As we all know, psychology plays a huge part in investing, money matters, finance, stock market.
Unfortunately, it does.
Unfortunately,
it does.
But that is the reality of it, Jim.
Yeah. Okay. Next financial mistake.
Next financial mistake. I think a good thing.
He's pulling it out of his rear end.
No, I'm really thinking to help our viewers.
Oh, I thought you had ideas before.
I did. I had my overtrading idea.
Oh, but I mean, after when I was talking,
I think
about something.
I think automating savings would be something I would highly recommend, and automating, like we talk about all these things, like your mortgage goes out every month, your car payment goes out every month, your expenses are relatively fixed, like your condo fees or your groceries and stuff like that. Why not savings? We should put savings in there. There's this whole thing that people should save.
Well, they should pay themselves first. That's probably something that they hear a lot.
Yeah. You should really focus on paying yourself first, and have your money allocated. A lot of people come back to me. I talk to them. Hey, how were you able to save this much? Well, I live at home, number one.
Yeah.
I still live at home, and I can afford to buy the place of my own for sure. That's not the problem. It's, again, based on what I want to do for grad school and stuff. There's no certainty in the next 1 or 2 years, so I wouldn't buy a place. Yeah. And two, I'm saving like $1,000 a month.
Yeah, at least $1,000 a month.
So, and it's good. I have a car, so I can go when I please and do what I want. But just the savings in that is huge, which allows me to put away. But even let's say I was living in my own place, renting my own condo, paying my $1,000 a month in mortgage, condo fees, property taxes, you name it, I would still find ways to save, and basically just by automating everything. There's a huge psychological aspect. Again, when you see money in your account, it gives you that comfort feeling that, hey, I have this buffer to go and spend and everything.
Yeah.
Really, if you really automate that and put your allocations aside, whatever you want to invest in, ETFs, mutual funds, GICs even, it's a start. I know Julian doesn't like them. It's a start though.
No, they have their purpose.
Yes. It's a start. And it's always good to automate it, get that out, and then you'll really see your money pile up that way. I think it's also a good idea to kind of don't break down everything maybe at the beginning and take, let's say you're making $50,000 in Quebec, the net you're going to get after that is $35,000, and then look at it from that perspective, saying, okay, I have $35,000 to live with on the year, and then you can break it down by month, so it's about $3,000 a month. Then ask yourself, like, okay, in a month, I get $3,000. What am I doing with it?
Yeah.
My rent and my expenses, that's $1,000. Okay, so I have $2,000 left. So now even if you take $1,000, for example, to do whatever the hell you wanted with food, going out, your drinks, your entertainment, your clothes, that's a good amount of money for one person.
Yeah.
I think, especially in Canada. And then you have your $1,000 to save.
Yeah.
So that's $12,000 net you save, plus the money you're kicking back at your work in your pension. So you're looking at maybe $12,000 to $15,000 in savings for a year, which on a $50,000 income is amazing.
Yeah, it's pretty good. It's pretty good. For my next mistake, I'm going to be very clear about it, and not as poetic as Ali, but it would be to not use I don't know how you'd call it, but the tools that are given to you by your government usually to save. So 2 examples, or 3. One of them is the TFSA. Right?
So you wouldn't use the TFSA, is that what
No, the mistake is to not using it.
Oh, the mistake is to not use it. Okay.
It's a podcast
to not use it. To not use it. Okay.
Yes.
Okay.
To not use it.
Okay.
Because, we already talked about the TFSA in our TFSA versus RSP episode, but just briefly put, the tax-free saving account is after-tax dollars that you use to fund it.
I came up with 2 new ideas.
But, good for you. You're on fire. But then all the money that you generate in it is tax-free.
Yes.
So it's a huge advantage. And you may not understand, like, I put in $2,000 and then I make 10%, it's $200. Like, the taxes on $200 is hardly anything after you take into account the capital gain rules and stuff. Like, it's not a big deal.
Yeah.
But $200 in 1 year is not much. But if you go for 40 years At the end, you take the 2,000, it becomes 80,000, it becomes 100,000. All that money's not taxed, so it ends up being 100,000 that you get to put back in your pocket. If it's in a non-registered account and you pay the tax on it, out of the, most of it's all capital gain, so you end up paying the taxes on 100K. You add 50% to your income, so 50K, and then you pay taxes on that, which is huge.
Yes.
And it really affects your gains. It's like a 25% decrease in your overall gains. So that's number one. Number two, we haven't really talked about this, but we should do an episode on that. I'm not sure what the American equivalent is, but it's the RESP. So the
401ks?
Registered Education
RESP.
Yeah, Educational or Education Saving Plan. And
that's for kids.
Exactly.
Kids.
Yes. It's saving money for university, college, SageUp, whatever, for your kids. And the reason why this is a valuable tool is that at the time that I was doing it, or my parents were doing it, for every $2,500 that they would put in per year, the government gave us $500.
Yeah. So they still do that. 20%.
Yeah. It's a free 20% per year. And people that aren't aware of this can't take advantage of this program. And, $500 doesn't seem like much, but $500
for 18 years.
For 18 or 20 years, $500 every year.
Yeah, about 20
compounded for 20 years. But, it's used for the first one. And then every year you get an additional 500. So you take it at 3%, at 8%, at whatever rate, and the difference that it could make for your saving school fund thing is huge.
Yeah. And
not a lot of people know about this, or not as many as should know about. Well, this is so bad English, geez.
Plus also, if for example, you end up in a situation where by the time your kid turns 20 and you're not in a great financial position as you were 20 years prior, at least the money is there and it's earmarked and the kid has something to go to school with. And that's also if you want to help your school with, if you want to help your kids with school.
Yeah.
We don't have to. You don't have to, but it's always nice to. It's a great way to invest, and remember, all that money is compounded, and the same goes with RRSP. Although you're taxed on your withdrawals at the end, all the money that you put into it.
But it's the student that's withdrawing the money, right?
Yes. So the student can only withdraw the money.
Yeah, he technically has no income.
Yes, but actually the money I think that you withdraw from the RSP you have to pay taxes on it. Not on the initial contribution, just on the gains.
I actually don't know because this isn't a podcast about it, but I do want to do an episode on the RSP.
Building on that point though, I think it's also very important to understand what goes into filing an income tax return.
Yeah, we actually made an episode on that.
I think understanding what deductions you have at hand, what receipts you should keep from throughout the year, what different ways you can kind of structure if you have, for example, you have a spouse, you have kids, how to carry stuff over, and just not to be an accountant and a wizard and a CPA. You don't have to be that. Just understand how some of the deductions work, how all of that works, and take advantage of all those laws and all those perks that the government has given you, and try to make use of it. Although there's always changes coming around, just be aware of some of the fundamentals in there, which account to hold money in, and it can always really help you out.
Yeah.
My other thing is...
I thought you had two.
This is my other one.
Oh, that was one?
That was one.
Building off my point?
Building off your point. Okay. Piggybacking. My other one is not getting a credit card when you're young.
Okay.
I think that is one of the biggest mistakes that people can do. And it's twofold. Number one, as someone that's young, it's very hard to build your credit score without a credit card. Because if you're 15, 16, you don't have that high of an income. And even if you did, you don't have...
Don't you have to be 18 to get a credit card?
I don't think so.
Yeah, I think so. Unless it's like a secured card with your parents. But
okay,
I remember,
even 18.
Yeah,
even 18. Even 18, you probably don't have those fixed expenses that are coming out, like mortgage...
or even like bill payments.
All
like
those bill payments, You may have your cell phone. You may have your cell phone, but all those bill payments that came out and that you have to pay month to month, you probably don't have. So the credit card is the best thing to show the bank and show creditors that you're able to make the payments on a steady basis on time
Yeah.
On time is the key point, and in full if you can. And it doesn't even have to be transacting hundreds of dollars. You can transact one lunch on it or one cup of coffee at Tim Hortons just to show the bank that you're making the payments on time, you're able to handle the credit card, and you can build through there. And it's a great platform to build your credit score. We've already talked about on numerous times the benefits of actually using a credit card for your day-to-day stuff, buying your groceries, buying your gas, using cash back, using points. But it'll come a time if you don't have a credit card, for example, and you get your first job and now it comes to getting a condo, there's a good chance, or whatever property you want, there's a good chance you will get rejected for financing because when they pull up your credit score, there'll be nothing.
Yeah.
There's a good chance that will happen. So be aware of your credit score. It's very important. And especially when you want to start making your investments, making moves, that is going to be a question and that will come up.
Yeah. Okay. Any other
ones?
Obvious mistakes? I mean, there's so many mistakes that we can come up with, but the point is to talk about the most
pressing, common,
easily missed mistakes and easily addressable mistakes at the same time. Like credit card, just being aware that 20% on debt is huge, and the return that you'll get in the stocks and real estate or in a company will most likely not exceed 20% year over year. And if your credit card will.
If you're carrying balances from month to month, your minimum payment will also go up from month to month. It won't be the $10 that we're so used to.
Yeah.
I think what's a good thing is on every credit card bill, it actually shows under the minimum payment, it says if you were to make the minimum payment, this is how long it would take to pay it off.
And it's like some 20 years.
For like $1,000, it'll be like 30 years.
Yeah, not so extreme, but it'll be like about 8 to 15 years.
Which is insane.
It's insane.
8 to 15 years to pay off $1,000.
Yeah, because you just make the minimum payment. The minimum payment is like 90% or 95% interest, 5% equity.
Yeah.
But then people still use the card to purchase stuff. So that
it just builds.
The debt keeps building and building, and then 20% eats you alive in no time.
Yes, it will.
Yeah. So, any other wise words of wisdom? I'm sure we can come up with 6 of these episodes to talk about financial mistakes, and we probably will. But we just wanted to let you guys know on the ones that are the most obvious to us and the most easily addressable.
The ones that make our blood boil.
Yes.
Now that we're smarter. Slightly.
Depends on how you look at it.
Depends on what domain.
Yeah. Anyway, guys, thanks for tuning in. As usual, you can reach us on Facebook at Personal Finance Boss and by sending us an email, even though it's very outdated now. It was outdated when we started, and now it's even more outdated sending emails. But our email is personalfinanceboss@gmail.com.
Emails are outdated.
I mean, just to reach a podcast or to reach something social media. I mean, we just have Facebook, a bunch of losers. Yeah, I agree. Anyway, and if ever you guys have topics that you'd like us to talk about, don't be shy. Let us know on Facebook or let us know by email, and we will be more than happy to address it.
Yeah, or let us know on YouTube in the comments, because we have that too.
Yeah.
See, we have YouTube.
Yeah, we have our 8 views on YouTube, which is great, but we actually have more views on the actual podcast.
That's true.
But
I think we should stop talking about.
There's no way for them to see that, right?
What do you mean?
The views on a podcast. Yeah. Oh, we have millions of views on the podcast, guys. Don't worry. Like, the information that we're coming up with is amazing. It's amazing. Okay, see you in the next one.